When we talk about things like GDP and we talk about PCE, home builder confidence, factory orders, consumer confidence, we mentioned again some of these yesterday and some today as well, it might sound like gibberish to some people. So Shanna, I'd love to talk about this today, especially considering that today, as you mentioned, we have an important one coming up. What impact do these economic numbers and the economy as a whole have on my portfolio? And maybe just kind of to start, what are some numbers that we should think of as some that are most important that might be a good idea to keep an eye on?
Well, I think the driving factor as of late has been inflation.
Yeah.
For so many years, we experienced almost zero, or not zero, but very little inflation, under 2%. And then we had COVID, and we had the government spending a ton of money, injecting a ton of money into the economy. We had supply chain issues. We experienced really high inflation. It peaked out at 9% in the summer of 22. So that is the driving factor that we're dealing with right now. And the Fed really has a couple of tools that they use to try. They have a dual mandate. Number one is price stability. So they're charged with keeping inflation in check by manipulating interest rates and money supply. And the second is full employment. So they need to execute this price stability without harming the labor markets and without causing unemployment to go too high. That's kind of their dual mandate. So, that's what we look at. Inflation is a big one, is an important one, because it impacts consumers directly. We have a consumer-driven economy. About 70% of our economy is driven by you and I having jobs, spending money, and continuing to operate, healthy budgets and being able to spend money. So, when consumers don't spend, companies make less money. When they make less money, they tend to cut jobs. Their profits tend to drop, and that causes their share price to drop, and that causes the market to drop. So, inflation really since January of 2021 through March of 2024, overall inflation has increased right at 19%.
Ouch.
That means, that it costs us 19% more just to do the things that we do on a daily basis than it did in 2021. During that same time period, the price of food jumped 21%, shelter increased almost the same 21%, and energy cost rose 37%.
Good grief.
So, it tells us there was a report out recently suggests that the problem is going to worsen if wage growth lags behind. So, I guess prices can go up as long as consumers' paychecks are going up and that they can keep up. If not, they end up eating into their savings. Once that's depleted, then they start to run up credit cards and act like the government's spending money that they don't have. So that's one of them. Inflation data, labor data is the other one, and that influences what the Fed does with interest rates. So if we continue to have these strong labor reports, which we have seen them weakening lately, then that makes it harder for the Fed to justify cutting rates. And then another one is going to be growth of the economy. So that's measured in GDP. We want to see the economy growing because that means that people are working. It means that, that tax revenue is going to increase. Now, unfortunately, the government just, if they see an increase in tax revenue, they spend it before they even get it. But, those are just a few of the factors.